Good morning, everybody. I am Jim Haley, the CEO of Dividend Assets Capital. I'm very fortunate today to have you all joining us on our webinar series. We look very proud to have Marc Saurborn joining us today, the Chief Investment Officer of our firm. Marc has been with us for a number of years now, and he has done an incredible job continuing the legacy of our founding partners with our dividend growth investment strategies and portfolios here within our private client group and our institutional asset management parts of our business. So today's session, we're hoping will be informative, insightful, and interactive. A number of our participants today have already submitted questions, but please feel free to submit questions throughout today's presentation, and we will address those as they arise. And without further ado, I turn this conversation over to Marc Saurborn. And I did forget one thing though, but at the end of this session today, if you do have any questions or any other follow-up, please feel free to reach out to us and we'll be happy to discuss those things further. So again, without further ado, I turn it over to our Chief Investment Officer, Marc Saurborn. Thank you.
Jim, thank you very much. And good morning, everyone. And thank you again for participating in today's webinar and webcast. So just to kind of get started with a couple of housekeeping items, talk a little about Safe Harbor. Anything we mentioned in today's webcast is not an expressed or implied recommendation. And, we just we want to make sure we cover everything before we get started. We're going to be talking about, obviously, market outlook, some of the names in our client portfolios, and just want to make sure that everyone understands that we're not making a specific investment recommendation. So a little bit of table of contents of what we're going to talk about today. There are some people on this webinar that may or may not be familiar with our firm. So just kind of go a brief overview of the firm, talking about our investment philosophy, why dividend growth, talk a little bit about the investment process, our strategy overview. Right now, we talk a little bit about our investment universe, may answer some questions about how we would hold up or how our investment process holds up through volatile markets. Talk a brief update about market year-to-date overview, and then kind of summarize. And then most importantly, we're going to go into some questions at the end, hopefully make it interactive. And so we can certainly address any questions or concerns. There's been a lot of news items. That's probably an understatement going on in the markets today. So let me just get started going forward. So again, brief overview about the firm. We're 100% employee owned. We help, simplify our wealth management, and, we deliver clarity, simplicity, and devotion to our clients. Most importantly, we are built on a pioneering 50+ year legacy of investing called the 3D process, double-digit dividend growth for a decade or more. And so we are, very, very focused on this, almost diligent in following that investment philosophy. So kind of core of what we do is this dividend growth investment process. So why do we do what we do? Why do we believe the dividend growth is so important? And here is a little bit of a busy chart. We have a table on the left-hand side and a chart on the right. And basically what this is showing is the difference between companies that continue to grow their dividends and companies that don't grow their dividends, and companies that actually cut their dividends. And so we'll highlight a couple of highlights here. So dividend growers and initiators back from 1973, we carried this all the way through June 30th of this year. Average annual return of dividend growers is about 10.2%. If you look at non-dividend paying stocks, you have far underperformed, or dividend growth companies have far outperformed over that time period, only 4.3%. And then compared to dividend cutters and eliminators, which are actually negative, if you can believe it, over that period of time, actually negative annual returns. And so, we look at this as a quality overview screen of our companies, and understanding that it's not just about the dividend growth, it's all the other virtuous things that the companies are doing from a cap allocation, from a management standpoint, and a reinvestment standpoint that continues to grow their earnings and cash flow over time that allow them to achieve these superior returns. talk a little bit about our investment universe, and we get a lot of questions about this from our clients and exactly what you're doing. So remember, we're looking at companies that have grown their dividends on average for at least 10% for 10 years or more. So that means in no years over that 10 years have they cut their dividends, obviously, or gone flat. So even in 2020, all the companies that have been in our investment universe today increased their dividends in 2020, which is a pretty small list if you think about the entire global universe of US listed companies. So only about 180 companies qualify for that. And that's basically the core of our investment process where we start to develop our individual investment thesis. So right now, the universe has about 93% domiciled in the US, only 7% international. It covers all sectors of the market, which is important from a diversification standpoint. And we'll also look at companies down to $1 billion in market cap. So you also get that multiple market cap exposure. If you think about looking at our universe relative to the actual S&P 500, which we use as a proxy, it's nearly double that of the on a 12-month basis. And if you look at it over a period of 10 years, it shows the same characteristics. So pretty significant difference in cash flow growth of those companies versus the broader market. So, very curated, high quality universe. That's where we start our investment process from. Talk a little bit about the characteristics of our differentiating factors of our core equity strategy. So if you looked at the annual year-over-year growth, again, this is as of June 30th, of our typical client portfolio, that dividend growth has increased roughly 11.5%. And over a 10-year basis, it's actually over 13, which is quite impressive. If you compare that to the broader index, S&P 500 as a proxy, it's nearly double. And certainly on a 10-year basis, it's more than double. So we can look at this as a quality. Not only are you achieving a higher yield, but your cash flow of your portfolio is growing more than double the broader market. And that's, very important. So we believe that, it's about quality versus quantity. And then this is just a typical portfolio looking at sample holdings. And so we have our 10-year dividend growth rate of our core equity portfolios. You can see it varies from a company like a Broadcom, which has been 37%, and down to say like a company like Microsoft, which is slightly more than 10%. Still greater, but you can also look at the years of dividend growth where they've been very consistent about continuing to grow that dividend. And I apologize for the confusion here on the right-hand side. Portfolio characteristics. What we're trying to show here is that the actual DAC equity portfolio has a much lower volatility than the broader market. And so one of those characteristics is that you're getting a participation in the market with a higher cash flow and a higher yield, but you're also doing it with a lower volatility, which we talked about earlier this year when we saw the market draw down 15+%. Our client portfolios are down much less. So we always look at, looking at the diversification impact of that and trying to minimize the volatility in your portfolio. Again, highlighting the dividend increases at the bottom right-hand side of this slide that, we're from a year-over-year basis, certainly much better than the broader market. And then over a 10-year basis, which we're investing for the long term here, more than double. And then if you looked at thinking about CPI or inflation, we use CPI, Consumer Price Index, as a proxy, well ahead of the 3% on a 10-year basis, and certainly on a quarter-over-quarter basis. So we're providing, the companies that are in your portfolio are providing inflation protection as well as cash flow growth, as well as capital appreciation. So we're trying to fit all, seek all buckets within this investment process. Next chart sort of highlights, and what I'd like to highlight is the growth in income. So this is something we do for some of our institutional clients, is showing them, especially since 2020, you can see the year-over-year annual portfolio income growth has been pretty significant. And one of the things I think that we've done more recently or over the past 3 to 5 years is really lean into our core competency, which is dividend growth. So the companies that we're adding to your portfolio are companies that are growing at a really, higher than 10% rate. And so you're seeing that year-over-year growth sort of compound, which is important as we go forward because we expect the companies continue to do that. So they're really sort of escalating or compounding that dividend growth rate, which is important. So you see the growth in income. We talk a little bit about the law of 72 here. And one of the things is why is that important? So we look at how long does it take to double your cash flow? So if we're talking about a dividend, if you're talking about a portfolio that grows its cash flow by at least 10%, that would imply that you're doubling your portfolio income every 6 to 7 years, depending on the growth rate. So then it doubles again in 14 years, and then it doubles again in 21. So if you're looking at it from a longer term standpoint, the compounding we call also yield on cost starts to increase exponentially, sort of like a hockey stick. And that's a real power. We talk about the power of this dividend growth portfolio is this cash flow. The cash flow continues to compound at an accelerated rate going forward. And that's the real power of the investment process. So kind of a little bit talk about the summary. We are rooted in Wall Street rooted, low country located. We're focused on this, our 3D dividend growth investment methodology. We're the only ones in the world who are doing this. We're very diligent. If a company no longer qualifies, it's removed from our client portfolios. It actually is the highest source of individual turnover or from our client portfolio standpoint. And so we're constantly looking at our investment universe to make sure that the very best companies are in our clients' portfolio. So, we are very, very focused. We come in every day attempting to do this. So I appreciate you. So I'm going to go back to, apologize for that. I go back to our summary. So talk a little bit about our year-to-date overview. So, it's probably understated that we've seen a good bit of market volatility from, last year, expectations, inflation, Fed potential rate cuts, and then we're looking through at the market reaction to that with tariff liberation day, and we're still dealing with that now. And why our client portfolios have performed so well, and why we believe they would continue to do so. So we're markets at all-time highs. There are many that believe that the institutions have a fear of missing out, and they're looking. I think the casual observer is looking and say, why the markets keep going up if we're seeing all this bad news in the headlines? And one of our advice to our clients is just ignore the headlines and listen to what our companies are saying. And that's what we really focus on here at DAC. We focus on what our companies are saying. And I would say by and large, our companies are very well positioned for this particular period of the market. We have a unique set of circumstances away from tariff and trade policy. We have a reshoring of what's going on in the U.S. economy, and then certainly the energy revolution that's occurring here, both renewable and non-renewable, which we can go into in some of our questions. And so we see the outlook for the U.S. economy and U.S. markets in particular is very bright. We're talking about, internally talking about the impact that AI is going to have on the broader economy. And our belief is that it's going to raise company operating margins quite significantly. And if you believe, like we do, that the reason why the markets continue to rise is because of earnings growth, companies are going to start to see an acceleration in earnings growth over the next couple of years. And we think that that's why the market is reacting the way it is, because they see this transformation occurring, this third, fourth, you pick your number, industrial revolution. We had our investment committee meeting this morning, and Jim was talking about the enhancement of productivity and how this is an analogous to what happened in the 1990s. And I think that is what's going on here, is that we really haven't been able to understand how AI is going to transform the global economy. But from a individual standpoint, our companies are accelerating their implementation of it, and it's leading to better margins and eventually better revenue growth as they continue to take market share. So, we feel very, very uh, confident about the future. We can't really predict short-term volatility. Obviously, the headlines go back and forth on a daily basis. But over the long term, we look out 2, 3, 4, 5 years. The outlook is very good for the U.S. economy and certainly the growth outlook. So I think kind of shifting to that perspective, I think maybe now would be a good time to address some of our clients' questions who have been submitted. So I don't know if Jim, I bring you back to.
We do, Mark. We have a good couple questions here, and I think some of this parlays into what you've already kind of said. We have a great question here that says, please touch on the advantage of dividend growth in a heavy bull market. It says, I've seen the benefits in the bear market, but what will it offer me and clients when everything else is way up too?
So if we remember the FANG stocks over the past couple of years, where we had a very small handful of companies contributing most of the returns to the entire market, we see that broadening out as it's a healthy process. And one of the things about dividend growth companies is because they are executing so well and they're reinvesting and they have very a disciplined capital allocation because of the nature of their dividend promise to clients and investors. They're taking share. And as so even when we get a little bit of a zigzag in the economy, they're actually getting stronger relative to the competition, both domestically and globally. And that's what we're really seeing. So as we come into a market environment where we start to see GDP reaccelerate, those companies disproportionately benefit. And that usually leads to share appreciation in those companies. So, as a broadening, long story short, a broadening of the economy actually helps our investment companies. It doesn't detract for them. And, there are going to be periods of time when individual companies may lead and lag, but more broadly, the entire universe of those companies should keep up with the broader market. It may not, keep up, say, with the NASDAQ, but certainly with the broader market, they're well positioned to continue to outperform.
We have another question here that says, how is AI outside of tech? How are our companies that we're following and within our portfolio benefiting from that?
That's a great question. And I think that's probably, when we look at the future, certainly for the US markets and more broadly the global economy, that's really the $64,000 question because all companies, it's gonna impact, and we were just in the, use a overused baseball analogy. We're basically in the first inning of this. We did talk a lot about AI, but they're using, sort of large language learning models, but the real power is an inference where they could have this, they use the base knowledge of all the data, and then they were able to extrapolate it into actual inference, like almost like, real, what we consider AI. And companies have just started that process. They're basically getting their own data loaded into these data models for their specific industries or company, and then they're able to use that to develop marketing plans. So we have a company in our portfolio is a global retailer, mostly domestic, but growing globally. They're using that from their marketing standpoint to be able to, so they're not using necessarily advertising firm, but they're using AI internally with their own data, their own customer data, and what they know about the market to help them save all that expense and be much more efficient in their marketing dollars. We have another company that does industrial distribution, and so they're using it to optimize their routes. So, every time their wheels are moving, they say, well, we're not earning money. When their wheels are stopped, which means they're making a sale. So they're optimizing their route both from a operating efficiency, but also they can optimize it from a sales efficiency, so they can target the best clients and with the highest sales. And they're just starting to implement that. It's becoming sort of integral into their business operations. And as they do that, their margins, so they've been actually been growing their earnings almost in line with the rev or even more quickly because they've been able to utilize these efficiencies in their operating margin. So we're seeing it, not just the tech companies, but all companies, whether it's inventory optimization, marketing, financial management, right down to the HR process, making sure they're hiring the best people. They're all starting to implement AI in all these different processes, and it's just started. So that's really where the excitement is. And I think as we go over the next couple of years, you're going to start to really start to transform large and small companies, particularly larger companies where they have a competitive advantage. So it's a good question.
I want to add, if I can add for that 1 second, Mark, for the folks who are on this call who are old enough and remember from 89 to 90, we're starting to hear out there in the media like what's the world gonna look like as we move forward, where or as Mark Twain says, history doesn't repeat itself, but it often rhymes. If we all remember from 89 to 99, what transformed in that 10-year decade, and I'm not saying we're not saying that's going to play out exactly for the next 10 years, but if we want to think about what could potentially happen and things look like from 89 to 99, think about that. And that's one message we're starting to try to share with clients is think about that world. We all remember that and all that progress. That's what we're doing now with AI and what's starting to happen in the workplace, and we're seeing it. So I just wanted to share that when you touched on the 90s. So another question that just came in here is um, so it says here, well, undoubtedly improved margins. Many companies are seeing layoffs due to that inefficiency, but if that becomes widespread, how will increased unemployment impact dividend strategy?
That's a great question. So there will be some shifting of resources within the economy. You're seeing some early signs of that even in college hiring. So some of the white collar traditional avenues that college grads would go into are being absorbed by AI. So that transition is occurring. Yet on the other hand, we have skilled trades and some blue collar people who actually build things there's a huge deficit of those. So we expect over time that you'll see that shift in the labor pool. So and much like the internet, people are, oh, you're going to get rid of the bookkeepers. Well, it created a whole new set of knowledge workers that were focusing on finance. So these transitions are occurring, but they're also occurring at a time when unemployment rate is low, and that there is still great pent-up demand for labor in specific areas. So, there is end demand. It's something that from a labor standpoint, I think the Fed is very focused on. There's probably going to be a period of transition, but we don't expect that you're going to see a big spike in the unemployment rate. You may see a little bit more unemployment temporarily as these workers get reallocated. But there's still a huge need for knowledge workers. Even as someone who's working, say, in a tech area or a traditional trade area, they have to be very techno savvy. So whether they're servicing and working on robots, or they're working within a factory setting, even a marketing setting, even in our industry, they have to be tech savvy, and they have to understand how it's not about the tools themselves, but applying those tools that are important. So, but we don't expect there's going to be, there have been quite a few economists are saying, well, there's trade or AI, you're going to see this huge spike of unemployment. But what's happening is a lot of the some of the workers are retiring. They're being replaced with younger workers who have this knowledge base, so they can just step in and handle a lot of those roles. And the economy will continue to expand. There's actually going to be more of those jobs as we reshore or nearshore the U.S. economy.
Yeah. So next question here, we've got several that have come in regarding tariffs. So tariffs so far seem to be used to leverage income. I'm sorry, to leverage to improve our position globally. Do you envision tariffs having a significant negative impact on businesses in the United States? And we have multiple questions here, Mark, around tariffs.
Yes. No, it's obviously a hot topic, considering tariff liberation day is kind of extended. I think it's From an inflation standpoint, it's usually a one-time impact. I think that US companies, if they're given visibility and they know what the playing field is, they will adjust. I think the biggest issue for companies that we speak with is that the uncertainty, they don't know which way to go, zig or zag, and how to plan over the next, over the longer term. But as these agreements get signed, and more information comes out, that visibility will improve. And we believe that, the best companies, which we're invested in, will react to that and take advantage of it. So, it's going to be, one-off here and there. We're seeing some of the deals come through. I think that certainty is going to provide, some comfort to the companies. They may not be happy exactly with all the details, but they'll adjust their operations, whether it's likely that a lot of that, the reaction by international companies and even domestic companies to a certain extent are going to increase their domestic sourcing and manufacturing. So that's a good thing for the US economy. And that's why you're seeing, company like Japan or Europe say they're going to invest, tens of billions of dollars or hundreds of billions of dollars in the US, because that's the way that they avoid tariffs. And so if they have domestic production, they're not going to be subjected to those tariffs. And so there's an incentive for them to redevelop their manufacturing base, which is ultimately what these tariffs is basically making it fair. Retracing some of the things that happened after World War II because of rebuilding of Europe and Asia, and kind of resetting that on a more level, the US on a more level playing field. So I think these are all good things. I think, Bo, we're going through this transition period right now where businesses and companies need to have some level of certainty before moving forward. And that's really, we're sort of in limbo. And I think that's where the biggest risk is right now. It's not as we go forward and there's these agreements get signed, businesses will adapt. Good companies, which we're invested in, adapt, and some of them adapt quite quickly. You'd be shocked how quickly they're able to react within a quarter or two. And what was once a liability is now an advantage. And so we continue to see that happening.
Yeah, yeah. We're getting a couple questions around energy demand, around AI, and as some of our folks know, we do have a energy infrastructure portfolio here, and actually we've had a couple questions come in around what's that going to mean for the energy space as we move forward in the U.S. economy.
So one of the things that I have an engineering background. I've been covering energy for over 30 years, so I feel like I have some sense of the direction this is going in. The U.S. is the low cost producer for natural gas right now, and certainly natural gas liquids, which there's an energy component, then there's an industrial component. And so we're basically able to export now in volumes that 10 years ago weren't even thought of. So from an export standpoint, there's still room to grow that. And I think you've seen recent agreements with Europe to kind of supplant Russian energy with US imports is a healthy sign. The second thing is domestic. One of the things we're building is this infrastructure of the future. So looking to the future, it's going to be AI, it's data centers. It's not about large language models, it's about the scale. So, and shifting from large language models to inference where we're actually using AI, takes a multiple increase in energy, like computing power direct correlation with energy. And so, we think there will be an all the above solution, but given the fact, even with less regulation, it would take 10 or 12 years to build a nuclear plant. Probably not going to build more coal plants, although they may run them a little bit more to their utilization. They're still closing. So we see that there's until we get to a more renewable future, whatever that is, natural gas will build the bridge, because it's much easier to build a natural gas plant than it is to try to build a nuclear plant from scratch or some other kind of plant. And so, but it's interesting, what we're seeing is that it's not necessarily the utilities are doing it, but the companies, we call it behind the meter. So they'll basically build a special purpose natural gas plant, which is a single cycle. It's pretty simple. to supply a data center, and then they could sell that excess demand if they have a capacity to the local utility or power grid. And we're going to see more of that going forward. Certainly, the backlog of a lot of the data centers is that, and they're going to be fired by natural gas. So after the past 10 years, we've really seen no increase in US total electricity demand. A lot of that is because of conservation, LED lights, LEED buildings, Energy Star appliances. That's going away now because we're transitioning to a more electrified future. And so to generate those electrons, they have to come from somewhere, and a lot of it's coming from natural gas. So the call on US gas demand is going to increase, as well as the global demand for natural gas and LNG. So, those are both great things for the US economy. Those are high value jobs. The US produces like you may, or which side of the argument you come on for fracking and unconventional natural oil and natural gas development. But the reality is the US is the lowest cost and the most environmentally aware producer of hydrocarbons. And so what better benefit would be to the United States than be able to lean into that, provide these high value, high paying jobs with great export market, balancing the relative trade, and grow our global GDP, taking that advantage of data centers. Because we are able to generate the electricity and supply those large data centers, and to basically drive the whole global economy when it comes to AI. And we can't secede or cede leadership to China. We know, they are typically haven't been a friend to anyone other than their own party, ruling party there. So, and they're not hesitant. If we've seen what's going on with magnets and some other things, they're using that, to exercise their global policy. So, if you're in Japan or South Korea or even Indonesia, and you don't want to be a vassal state of China, you're going to be looking toward the United States to supply your energy needs. And that's what we're seeing. It takes time for these infrastructure things to develop, but if we can keep the AI lead as well as the energy lead, they're actually intertwined. And I don't know how many people really understand how closely intertwined they are, but they're intimately intertwined. So we can maintain our energy leadership. We can also maintain our AI leadership, at least for our, for the rest of the world. So those are great kind of longer term growth drivers. We talk about secular, what you're looking at a long term, what's going to drive the economy, the US economy. Those are one of the things. We maintain our technology dominance as well as our energy dominance.
It's a great answer, and what keeps flowing through here too, we keep getting questions in here. I'm going to try to address these because we have a theme kind of flowing here. Is big beautiful bill, deficits, and interest rates. So, which one of those do you want to tackle first, Marc?
Well, let's think off the easiest one first. I think interest rates. Clearly the headlines, have been putting a lot of pressure on Chairman Powell to lower rates. The rest of the world is doing it. Even the Fed itself admits that it's too tight. Where are we seeing that results of that? The housing market. It's one of the areas where it's been lagging. And, I believe, and many others believe, it's because interest rates are too high. Of course, real estate prices are high, but if you can't afford to make your monthly payment, then you're not going to be able to move into a new home. So that's been a big issue, and it's something that the Fed could fix. We think they're probably 75 basis points, too tight right now, maybe even 1%. I wouldn't say they should take interest rates down, 250, 300 basis points right now. Now, what's going to happen if the Fed does start cutting? Well, it's certainly going to help companies refinance their debt. So that's going to help some largely more levered companies, like industries like REITs, even the energy industry per se. It's going to help them from a refinancing standpoint. Now, the Fed doesn't control long-term rates, but they certainly can influence them. And if the inflation outlook, which has been declining, it's clearly been declining over the past several quarters. And right now the bogey is tariffs, which we could argue is going to be a one-time impact. We don't think that's an inflation escalator, even if it's implemented. The Fed's got room, and that's only going to help stimulate the US economy. And so, so we see that we see several rate cuts in the future. We would hope they would have started already, but they haven't. We do think we needed a leadership change at the Fed. I'm not going to get into politics, but I think that they're being a little bit late now, and it's only because the underlying resilience of the US economy that's not having a greater impact. But the longer they maintain this policy, the greater that risk becomes in the future of slowing the economy down and really providing more of a significant headwind. So we think that logjam will break, whether it's tomorrow, probably not, or in September. And rate cuts are kind of like potato chips. You can't eat just one, so they don't just do, they have a renewed target rate that they're going to, and it's probably about 75 basis points to 100 basis points below where it is now. And so we think that's likely to manifest itself over the next 12 months. We'll see a significant decline in short-term rates.
So
what else are you talking about? Inflation, big beautiful bill. Or sorry, I didn't think I addressed it. It's so big beautiful bill. So there's a little bit of something for everyone in the bill. And certainly is an extension of the prior tax cuts. So so some of it is do no harm. There was some SALT increases there for people in the high taxed Northeast and West. But I think the more important part of it is the accelerated depreciation for businesses. So they're going to be able to write off investments. So it really motivates and incentivizes capital investment. So if you're a company that's thinking about making, building a new plant or, maybe buying a solar farm, I'm being facetious, obviously, buying a behind the meter natural gas plant, you're going to be able to appreciate that against your income very quickly. So that's a very attractive for businesses. So it is very stimulative in that way for capital investment, not for spending, which is, you could even the most ardent pessimistic economists would say, yeah, capital investment is better than just promoting, sugar rush spending by cutting everybody $1,000 check and just go out and spend it.
Yep. And I don't think many folks realize it was a $226 billion supply side infusion into the United States economy.
Yep.
That's a huge impact. So, and we talk about it in here too. Deficits. Get a couple questions here. We worried about deficits and as we move forward and how that will affect our company's overall economy.
Yeah. I mean, I'm not drinking the current administration's Kool-Aid about how tariffs are, putting the budget back. We're running, they're running a surplus. I don't know if that's, going to be happen, for over the long term. But we don't have a revenue problem. We have a spending problem. And I think that both sides, the most palatable solution is to grow the economy out of it. And I think that's what they're doing. So, right now, expectations are that the economy is not going to grow very much. We believe it's going to grow at a much higher rate than the congressional, economic board is looking at, or the forecasting board agency is looking at. And so we think that the plan overall is just to grow the economy so that debt becomes a smaller portion. Obviously, you have to take steps to slow spending, which they have done. And so there's been a lot of, hand-wringing and machinations about that in DC. But it's probably necessary. We need to, much like the US population with Ozempic and some of the GLP-1s, we need to go on a budget diet. And I think, pushing the burden of spending back into the private economy is a better solution than government mandated or government wealth transfer payments. So, I think that's a healthier structure going forward. I think it leads to a higher future growth rate, frankly, and higher GDP growth for the US economy, and where everybody benefits rather than just a small selection of individuals. So I think it's going to happen. I mean, there's some things in there for everybody, right? So no tax on tips and overtime up to a certain income level. That kind of, maybe that's more kind of headline fodder for the grist mill. Does it have much of an impact? maybe at the margin, certain places, but I think the more important part is the less regulation, which we're starting to see, and then the accelerated depreciation, which promotes real capital investment, is going to be the real sustainer. Growing the economic capacity of the U.S. economy is much more important, I think, than just the overall tax cuts.
Right. So we've got a couple more questions here, but we're bumping up against the time we've allocated. And again, a couple questions here, just saying, asking are going forward. I think we've already answered that. We don't see any signs of recession going forward, at
No.
least not anytime soon. There's a couple questions here that I think we've already addressed around what makes our dividend growth portfolios unique going forward. I think we've answered those pretty much. But for this bumping up against time here, what are three takeaways, Mark, you think our folks listening today should kind of walk away with as we wrap things up here?
It's a great question. I think one of the most important things is that the companies we invest in are the really a unique quality universe. And when they get stronger when there's volatility. And when things become difficult, they have the ability to reposition themselves and use it to their advantage. And we've seen that, time and time again over, the 20 plus years that DAC has been in business, even before when Mr. Cameron was running his strategies 50 years ago. And I think that, that thesis really holds well for the future. The other thing is that as the market broadens out right now, which I think is happening, as more companies participate in this growing economy, that's going to be better for companies that pay dividends. They're going to have, what are they going to get benefit from? A better operating margin, better cash flow. Better cash flow for equal dollar of sales, they're going to generate more cash flow. And because these companies have a commitment to returning that capital to shareholders, not only are they going to have to invest less because they're going to be more efficient, they're going to have more free cash flow. We would hope to increase their dividend payments and distributions to investors, and not, we don't. There's probably some M&A activity that's going to go on, but we think that by and large, at least for most of our companies, they'd rather return that capital to shareholders, and they see dividends as an important way to do that. So, when we had that drawdown period, and by the way, it was the quickest recovery from the 15% drawdown, I think, ever on record, from April into June. We get excited because the companies that we really have confidence in, we understand the intrinsic value. When they go on sale, we get excited, and it allows us to be tactical and to be, we don't know, when the market opportunity presents itself, but we are always ready to take advantage of it. And I think that's somewhat unique, that we gain in confidence when the markets get volatile. And the reason why we're able to do that is because we have such a great group of investment companies. And so I think that really distinguishes us. We're not trying to chase the bright shiny object. We're able to invest in the long term, and focus on the cash flow and the intrinsic value of our companies. And we can be patient. We can be patient investors. And I think that leads to long-term returns for our clients, and better investment outcomes. And we're seeing it now. So we're not, we're seeing much less volatility, and we're seeing more upside participation as this market and the economy continues to grow.
Yeah. And the thing I'd like to have some folks walk away from our today's session too is, I think a lot of folks are going to be surprised at the power of this economy moving forward. We're seeing it, as Mark said, in our numbers. I think we're going to have a lot of folks surprised by that. And what I hope we can close out here is think about what happened from 1989 to 1999 in that 10-year transformational period. We are as Mark said earlier in this call, we are in this session, we are at the second inning of this stretch, of the first and second inning. And we don't know what that's going to look like over the next 10 years. We have an idea, but the closest thing we have in history is that from 89 to 99. So, But with that, we bumped up against our 45-minute timeline. We thank for everybody here who participated in today's session. We tried to keep it as short and brief as we could. Some of these talking points, we could have probably spent 45 minutes just on that. But if anybody on today's session would like to talk further, has any questions, feels free to reach out. Myself, Mark, Alex, the rest of the team, we're all here. And we thank you for joining us today. So thank you.
Thank you, everybody. Thank you, Jim, too.